Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and I am here again for another Investment Friday with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. It's July 11th. It's Thursday, July 11th when we're recording this, so it'll come out on Friday, July 12th. Brad, what's up, man? What's going on?
Not too much. Depends on what part of the market you were participating in. Some parts were up a lot and some parts were down a lot. So it just depends on what you own.
So we're talking kind of headlines today from the last couple of weeks. So yeah, what are some of the headlines around that? Like what was up a bunch and what was down a bunch this week?
Okay. So this morning, we got the most recent for June consumer price index data. And that tells us that's a measure of inflation for the average urban consumer across different metropolitan areas in the US. And so it had come in softer, meaning the inflation was lower than was expected. It also bolstered what Chairman Jerome Powell had testified in front of Congress this week, in which he said, "Hey, if we get more data that inflation is coming down towards our target, we're going to start reducing interest rates." And that's great because that is in line with what they've been saying for the past couple of months. And with this most recent data from the CPI coming in softer, it's giving investors more confidence that borrowing costs are going to be coming down. So it'll help households buy new houses to get more affordable mortgages. It'll help the regional banks who are currently stuck or suffering with some empty offices, that now they can refinance some of those properties at lower rates and make it a little more affordable for them. Additionally, it will also help the US government lower some of their interest costs, which, as we've all been talking about, both in the media and we've also discussed on the podcast, those interest costs are going up quite a bit.
So that actually leads into a really good, first topic. There was an article that came out last week. Let me see if I can go back to that, about the state of the debt. $91 trillion worth of debt. So this was an article from CNN on July 2nd. So this has been, right, a conversation that we've been having, at least in the United States, globally, for a while, about what is the amount of debt that we can actually maintain. Is the debt a problem? Is it not a problem? We have economists kind of on either side of that issue. But with interest rates being as high as they are right now, that is really at a tipping point, isn't it? Or is it not? What do you think?
It's a great question. And the debt problem is, one, the US can afford their current level of debt. No problem. Okay. Well, I shouldn't say no problem. It is a little bit of a problem because the interest rate on that debt has gone up substantially over the last 2 or 3 years. However, we also have to look at it in terms of net worth. Okay, so there's two ways to look at it. One is the stock of assets that support that level of debt. And what is that? As of 2024, the United States has a $269 trillion in assets. Okay, so 269, and debts in total, this is including corporate debt, household debt, all of that debt, of 145 trillion. Okay. So that's manageable. That's actually really not great, but it's not terrible either. That's one way to look at it. The second way to look at it is debt sustainability, meaning can you fund these costs? How much longer can you do that? Our debt, and our debt I'm going to talk about is just the United States. So the 91 trillion actually included all the government debt around the world. But what I'm going to do is actually break out the United States from everyone else, just because that's mostly what people are concerned about in the US. One is, can we sustain this debt with the current interest rate costs? Yes, but it is starting to crowd out other spending. All
Mm.
right. It is starting to, for example, a dollar that comes in, does it pay off debt? Does it service the debt? Or do we use it to provide other goods and services? Well, right now, a lot of the new money is actually being funded by new debt. Right. Last year we had a primary deficit of around 6% of GDP. That was funded entirely by debt because the taxes don't even come close to covering that amount of outlay. So that primary deficit, which we've heard a lot about during the election cycle, they're talking a lot about that that deficit spending. It's important to keep track of that because we were spending in deficit levels at a time where we had record tightness in the labor market, where we had inflation at elevated levels.
Mm.
That's the wrong time you want to do deficit spending. Theoretically, deficit spending should be used during times of economic weakness, recessions, depressions. That is when the US government should be stepping up and going, okay, we're going to put people back to work doing some projects. Okay. Upgrading the infrastructure, repairing and building new bridges, putting in new electrical grid that's much, much more efficient, not relying on the 1920s and 30s technology. There's lots of things that we can do. It's just generally we reserve those for those weaker economic times. That primary deficit, because it's such a large amount, adds to our debt significantly over time. And that is where a lot of economists are starting to ring the caution bell and say, look, our level of debt is sustainable, but our growth in that is unsustainable. And
Mm.
that is absolutely the case. So we do not want to get to a point where we're adding to the debt so much every year that we really will never catch up, or not never catch up, but we can't catch up without some real draconian measures, shrinking the government substantially, cutting back on defense spending, cutting back on Social Security, Medicare, Medicaid, all of the programs that we currently rely on.
So would this be the question that kind of came in while you were talking about that, would this be more of an issue for the equity markets or for the bond markets? Or is it like at that point, if something breaks, everything's going down with it?
If something breaks, it's going to take all assets with it, regardless, because the value of an equity or a stock is dependent on the cost of financing, right? So
Mhm.
the risk-free rate is something that we in investments we use as a as part of almost all of our models to value equities and to value different investments. And so if that risk-free rate now is broken, because we proxy that rate with the US Treasury yield. So
Mhm.
if all of a sudden the US Treasury yields are not going to give us accurate information, then the valuation of those risky assets is going to be very, very difficult. Not impossible, but just very, very difficult. Um, and so if the US gets itself into a situation where we do have to do draconian measures, what people don't may not understand is that that is going to cause shrinking in that part of the economy.
Mm.
So if transfer payments get cut, if benefits get cut from Social Security, Medicare, Medicaid, if veterans benefits, if do, domestic, defense spending gets cut, that's going to shrink our economy to a certain extent, which means we're going to have to rely on the consumer and the corporate sector to really fill in that gap, or be okay with the fact we're going into a recession.
The last thing that I'll say here, that was also kind of in my mind, was that the thinking back to it wasn't that long ago, right? It was under Bill Clinton, I think, that we were in a budget surplus instead of a budget deficit. And I don't know, maybe you know this, like if tax rates were higher then. I think they were.
Mhm.
Tax rates and
Sure.
corporate tax rates, back in the 90s when he was president. So is there is there this case when we're looking at, because we're going to talk about presidential candidates a little bit next here, um, when we're talking about the potential for, on the Republican side, cutting taxes again, cutting the corporate tax rate. That's another thing that's been floated from 21 down to 15%. All of these big tax cuts, to me, it sounds like they're only going to serve to accelerate that debt even further. Right. So if the issue is that, like, okay, we can manage this level of debt, but we can't manage how fast it's been growing if it continues to grow at that speed. If that's the problem, it feels like, these aggressive tax cuts are going to be counterproductive for that part of the economy.
Yes, you're absolutely right. Um, if you don't cut spending and you do cut your revenue, which
Yeah.
taxes are the revenue this year, right? Um, Generally what's going to happen is you're going to go further into debt, right? You're going to have to finance that spending somehow, and that is more debt. And so um, there's a trade-off between higher tax rates and the amount of new revenue generated. It's not one for one,
Mm,
because higher rates discourage certain types of economic behavior. And so it restrains. So, for example, the higher the tax rates, the more people will try to go to avoid taxes or to evade them, or to just not transact because they don't want to pay the tax on whatever they're doing. Um, and so it's not a one-to-one relationship, and so it's something where there's um a nuanced deal or a nuanced rate at which equilibrium is where we get our maximum revenue per for that tax rate. um yeah, I don't know exactly where that is. I think that lower tax rates from any political party is a nice notion. If we're lowering rates from very, very high tax rates, then generally they give an impetus to economic behavior. They encourage more economic behavior, which is why people say lower tax rates and all of a sudden your revenue goes up. That is generally true if the initial tax rates are high.
mhm.
Right now, our initial tax rates aren't high. They're actually low compared to history. So it's I don't know if it will encourage it that much more. Um, but it's an easy political talking point. Um, so candidates throw that out all the time.
Yeah, exactly. Well, from that, like the economic impact of what that could be, right? Let's switch over to, kind of a talking point that's been really heavily in the news lately, which is, what if Joe Biden steps down as the Democratic nominee, or if anything happens? Um, and if we had a Kamala Harris presidency instead. She's current VP. One of the technical pieces that I heard recently was that, since she is on the docket for it's Joe Biden and Kamala Harris are the ones that are written down in writing that these are the nominees for president and vice president. She would be the one that would be, if he steps down, she's within that process already versus bringing in someone completely different. Um, but I don't know. I don't know what that looks like. So if that were to happen and we were to have a shakeup in candidates in some way, shape, or form, what might that look like? Because we've talked before about, the presidential election years and what that typically looks like in the markets, and that the markets most like when the incumbent stays because it's familiar. And so that's when we have the most stable market conditions. What if there's no incumbent this year? What happens?
Yeah, that's a great question. I've thought a lot about this, whether the Democrats, because of all of the media since the debate, all the media coverage of, whether Joe should stay, whether Joe should step aside, what would happen in that case. And it's my understanding, and I'm not a political expert, so please take this with a grain of salt, but it's my understanding that at the Democratic National Convention, they can nominate someone other than Joe Biden or Kamala Harris. Okay. Now, to your point, Kamala is probably the most likely because she is already on the ticket, per se. She already has a number of states that have voted for Joe and Kamala. So it seems like that would be an easier replacement, but not necessarily 100%, because they're trying to really energize their base in competing with Donald Trump. So if Kamala Harris were to take over the nomination and run as president, the markets would be less perturbed, just because, again, she's part of the current administration. If they pursue the same type of policies that they have over the last 4 years, more likely than not, it's not going to be a major change from the course of business. That said, if they nominate a third party, which is currently unknown, depends on how familiar the market is with that individual.
Mm.
Because now you're introducing two new, right? You're introducing a new presidential nomination, or presidential nominee, and a new vice president nominee. And if the market doesn't know them, let's say they're relatively unknown to the average investor, that may cause some volatility, right? We kind of know what we're getting with Donald Trump. Even though he's very erratic and very mercurial, we've been through 4 years of chaos before. And with Joe Biden, we know what we're getting. So Kamala Harris, we kind of know what we're getting. A third party would introduce a little uncertainty. And again, the markets don't really necessarily like uncertainty that much.
And to add to this conversation a little bit, what we also have noted on the podcast, if we really look back at history over time, the thing the markets like the best is when there's gridlock in Congress, right? Like that's truly what they really like, is that, like, oh, nothing's going to happen, so everything is we're just going to keep doing what we're doing and not worry about it. And from a policy standpoint, and from, that piece, like, okay, that's not great for moving things forward, or having Congress actually work in a way that there seems like they're working for the American people, right? Talking about things that we want them to talk about, because nothing's happening. So I feel like there's frustration there. There's frustration for me. I'll admit that. As a human
Well, I
being
think
that has an opinion.
yeah, I think everybody in the center is frustrated with this,
Yeah.
with the last two presidential races, but this one in particular.
Yeah. Yeah. And we've talked about that a little bit. I'm a little bit left of center, but definitely a very moderate person. I see both sides of the issues very, very clearly most of the time, and want to know what's best for humans, what's best, and we talk about this on the podcast all the time. What's best for the actual people that live here? What's best for American citizens? What's best for the world citizens, right? Like what is a good option for human beings to connect with each other and to help each other? And when that's not very clear, like who's going to be the best from that standpoint, I'll hold my full political judgments aside. But that's truly right. That's what I'm looking at. And so for the market as a whole, stock market again likes to see gridlock as a source of stability for itself.
Correct. In fact, historically, the best equity market returns have come with the Democratic administration and Republican Congress controlling both parties, Republicans. And so that historically has given you the best equity market returns. So, you know, part of that is because, well, they're at each other. They won't, they have to compromise. I think anytime you have a party or parts of any party that will not compromise, that is a bad thing. They're not doing their job. And I don't care whether you're Democrat, Republican, Libertarian, Green Party, whatever. If you have a representative, a senator in Congress that is not negotiating with the other half, the other party, then they're not doing their job, and they're actually impeding the government
Mhm.
in doing what's best for the U.S. citizen. And so that's my 2 cents.
Well, we went we went deep on this today, I feel like. And I think we're in that stage, right? It's July now. Election happens in November. We're in a phase, right? We're just kind of waiting to hear. This has been for a for an election year that, we have an incumbent that could be president again, right? There's been more turmoil than what we would normally expect to see. And so I think there's just a lot of wait and see what happens at the Republican National Convention in a few days here in July, wait and see what happens at the Democratic National Convention in August, and then we'll just wait. We'll wait and see. And the market's going to wait and see, and that's all.
Yeah, it's going to be eventful next few months. That is for sure.
Mhm.
From now until, possibly the end of the year, but definitely until November 5th, we're going to have a lot of uncertainty introduced. We're going to have a lot of my guess is we're going to have a lot of volatility just simply because of the equity markets being near their highs. Uh,
Mhm.
so we'll see how that all turns out.
Yeah, that's another good thing to like bookmark at this moment too in July. Like we're seeing highs over and over again in the markets right now. And what that typically does, right, is when we hit a high, there's typically a pullback from that. We don't hit a high and then stay there and then hit another high and stay there like we're going up a set of stairs. We usually hit a high and then pull back and then another high and then pull it back. So when we see the volatility over the next several months here, like yeah, just being aware that that's normal. And most accounts we just posted some different numbers, and we're looking at all kinds of stuff inside at Juncture right now. Most accounts are up pretty significantly this year to date. Over the last year, we're seeing some really positive numbers in accounts overall. And so sometimes that's an indicator. Yep, like this is great, we've had a really great year, we might expect to see more of a pullback.
Exactly. Exactly.
Did I say that right from a
You absolutely did. Nailed it.
got it. Did it. It did my job. So thank you for everyone that sent an article, sent a question, As we say every time, we love to receive that from you, and we love to hear your thoughts. We'd love to hear your opinions on things as well. So feel free to share that. You can share that with me at Hannah, Hannah, at expansiveceo.com. When you talk about the podcast, just say question from the podcast or notes from the podcast. Love to receive that from you. And Brad, how can people get a hold of you?
You can hold me at Haines, Haines at juncturewealth.com, or give us a call at 480-253-4100.
All right. Well, thank you so much, Brad. It was so good to have you here this week, and we will keep up and see what's happening next week in July. Sound good?
Sounds great.
All right. See you then. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, Hannah, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.